I'm going to keep the focus of this presentation a little bit on the practical side. But I think to begin with, I wanted to also give the big picture of why energy efficiency is important, yet very complex, and yet doesn't happen. You've heard people talking about money lying on the street. It's literally money lying on the street, which nobody should think would be difficult to pick up, but it doesn't get picked up. Even the low-hanging energy efficiency options sometimes are very hard to implement. And what Debbie was mentioning, when you talk about scale, implementation at scale, it's even more challenging. So you have a lot of pilot projects which are done, by many agencies throughout the world. But taking that pilot to an actual large-scale implementation is where I think the World Bank's expertise is in. And some of these experiences which I will share, you will see, it's this scale which really matters. Because if we talk about the 2 degrees Celsius target or the 1.5 degrees Celsius target of climate change mitigation, you have to go beyond pilots. You have to do large-scale implementation. And the energy efficiency by itself is such a difficult subject in many countries because it faces many barriers. When you try to do it at scale, it does run into problems. So some of these, I would say, experiences which you will hear about are again being tested, being tried out. It's still evolving. Energy efficiency is not as simple as putting a solar power station or rooftop solar project. I mean, that's what we say. And it continues to be a difficult area full of challenges. So World Bank and also the Asian Development Bank, which I have worked with in the past, or USAID, we all focus on the developing countries. But developing countries, of course, benefit a whole lot more from energy efficiency if you compare them with what's happening in the developed countries. Many of these projects in the developing countries are not driven by climate change mitigation. They're really driven by the scarcity of energy resources, the high energy import bills, the blackouts and brownouts which happen all the time, which affects day-to-day human life and day-to-day sort of well-being. And energy efficiency is really seen by us as one of the solutions which helps in overcoming all those problems in the energy sector. Of course, climate change drives it at the end of the day. Even in the World Bank, we have climate change commitments to the international community, and we try to do energy efficiency as a part of that commitment. But at the country level, at the developing country level, it's those benefits, those private benefits, which really come out of this public good, which matters a lot. So this slide really talks about how we meet multiple benefits through energy efficiency. On the right side is this nice sort of diagram which came out from the International Energy Agency a couple of years ago. You might have seen they try to capture it and to show how the benefits could vary from just simply creating more jobs in some countries to providing more reliable electricity yet in some other countries, to making their industries more competitive in some other countries. So I think our projects really try to pitch energy efficiency through one of those platforms and windows. And that's how we engage countries and convince countries to adopt this as one of the pillars of climate change mitigation. And again, these are quite well known, but the point is always to be remembered that if you go to a country in Africa, I worked in Uganda like about 10 years ago. They had hydropower, from the Nile River, which went down. And what was happening, there was lots of blackouts because there was no electricity to serve even the population, even within the capital city of Kampala. There, if I went and talked about climate change, it probably won't ring a bell. But what they wanted then is to actually find solutions to address their blackout problems. So energy efficiency became one of the ways, hi Vijay, good to see you, of addressing that problem. I work in the Middle East, in Saudi Arabia and in Qatar, for instance, right now. energy efficiency, of course, climate change benefits is there, but they have a job situation in the Middle East which is very serious. A lot of unemployment. So we try to bring in the employment angle of energy efficiency co-benefit when we start to talk about energy efficiency in the Middle East, for instance. So the point is that it really does bring in multiple dimension, and of course it saves kilowatt hours and dollars and GHG emissions, but they're yet the way to convince governments and private sector and industries to adopt this is to pitch it through a much more broader set of multiple benefits of energy efficiency. And to be very frank, we keep talking about efficiency as a problem, but actually in the last 2 decades, if you look at the record of how countries, even the developing countries, have behaved in terms of improving efficiency, it's been quite positive. Sustainable energy for all, who I'm sure most of you have heard about, or some of you might be working on it, which is this UN World Bank joint initiative, which started a few years ago, basically started tracking the trends of energy efficiency across various sectors across the countries. And if you look at those graphs on the left side, the bar diagram, basically it's all showing that the primary energy intensity is coming down across the global sort of scale, but also in individual countries. If you look at not only the European Union, US, but China, India, and many other countries, the trend is very similar. The green line is the energy intensity line, which is really going down. And while the GDP in these countries, particularly in China and India, are growing dramatically at a very, very, very high rate, which means that there's a decoupling going on between how GDP is produced and how much energy is needed to produce that GDP. So I think that is what the objective of all energy efficiency projects and professionals are, that you try to decouple and make sure that you don't sort of compromise on the economic growth and well-being, yet you use less energy to achieve that economic growth level and well-being. I mean, that is really the idea behind doing energy efficiency. But yet we saw the IPCC report, which came out two weeks ago, and quite alarming that the record, though, is good on the efficiency side, but we have very little time between now and what could be possibly be a 2°C scenario in a couple of decades, unless we do a lot more than what we have done in the past two or three decades. And this particular chart really comes out of the energy efficiency market analysis done by IEL, which was launched last week. If you do a Google, you'll find this report, which was launched. It's a very good analysis, which actually shows that even under the current policies, if you look at the total gigatons of CO2, what you desire in 2040, it's still going to go up unless you do dramatic improvements in the energy efficiency sector, as well as in the other sectors, of course, renewables and fuel switching to come in, and people talk about nuclear as well. What the IEA calls the sustainable development scenario. Unless you do that, this is what you desire to achieve the 2 degrees or 1.5 degrees Celsius. And with the current, even with the current policies and the new policies which are around, this is not going to be achieved. And on the left-hand side, the similar sort of analysis which shows that this is the new policies, but even you can do a lot more beyond those new policies. The dotted hashed line basically shows the potential which we are missing out, which many countries have not even set the stage for doing that work. I mean, the solid bars are what we know, what is being done today, but the hashed part is what could be done. Now think about it, you have just 2 decades left, and people are still thinking, or not even thinking maybe, we are trying to help them think through those hashed bars. So the point is, in spite of all this potential, and this graph shows the cost of saving energy, people claim, and we know, and we have proven data to show they're cheaper. It's always cheaper to save energy than to produce energy. This is again the so-called McKinsey cost curve, of course, which started with the GHG emissions, but it's a McKinsey cost curve for the energy efficiency part of it. And the dotted lines and the difference is what is the difference in cost of supplying versus saving. So for instance, electricity for or gas for space and water heating versus electricity for cooling, you're paying that much per unit of energy, but to save that unit of energy, you require a lot less in terms of the dollars to be invested. So the point is, they are effective, they're cost effective in the long term, yet how do you really make this happen? The problem is that energy efficiency, when it comes to implementing, goes through a lot of these, I would say, barriers and challenges. The first barrier, of course, is the macroeconomic situation of energy prices. If your supply side price, which is the price of electricity per kilowatt hour or natural gas per BTU, or tons or dollars per barrel of oil, if it is not priced correctly, obviously energy efficiency will not have a good head start. So that's for the first barrier energy efficiency faces. Then of course comes with the kind of market and financing barriers, that it's not as simple as setting up a power station. A 200 megawatt power station, a 500 megawatt power station, or even a rooftop solar on this building is a much more straightforward action than comparing that with putting these LED lights in this building. It's difficult because then you are actually measuring this by the saving of this LED, which the LED light is bringing. And the concept of saving is not something which people understand that easily. Whereas when you put a rooftop solar, it produces electricity. You can sell it, you can use it. So I think this virtual concept of saving makes it even more difficult, and the smaller size of projects makes it difficult in the marketplace. Then of course there are issues like, I know there's a good buildings program here in WRI, and you've done a lot of research in this area of the split incentives in the buildings case, where if this building tenant was somebody who really doesn't care about saving energy, the owner is probably going to put a system which is really the cheapest and the least efficient. And business as usual will go. But then yet, if you have a very progressive builder and a progressive renter, they can fix things in this building if the incentives align themselves. But usually that's not the case, because when you rent a building, you are really, or when you build a building to rent, you don't really care about how much the person who's going to rent is going to pay for electricity. And I think that split incentives problem comes very big in the building sector, for instance. So there are those market barriers, and also the procurement barriers and financing barriers. For instance, you go to a municipality, they have street lights which are mercury vapor and sodium vapor inefficient lights. They get a budget, they pay for the electricity, and life goes on. Now, a company comes in and says, we're going to put in LED lights, which are going to cut down your budget or cut down your expenses. Problem is, they're not set up for procuring based on energy savings. A municipality is set up for procuring based on the lowest cost. And the lowest cost is always the inefficient mercury vapor lamp. It's not the efficient LED lamp. And that's where those policies and practices come as some of these barriers. And this again, it's not something which cannot be overcome, and we'll show how this can be overcome, how policies can be put in place, how programs and solutions are around which can address it. But then moving from those macro barriers to project level barriers, you always will have a problem that energy efficiency will have a higher initial cost. Now, the initial cost is sometimes the decision-making factor. Many consumers have a very high discounting rate, which means that the benefits which they get down the line don't matter. What matters is how much am I spending today to get something. And that's how our minds are trained, right? And I think that's the biggest challenge, that how do you somehow securitize the savings or the revenue stream which comes down the line 10 years from now and will pay for your investment, how do you make it relevant to the consumer so that they can make a decision based on that? Even industrialists sometimes don't think that way. They think about a payback period of 2 years, 3 years maximum. A street lighting project, for instance, pays back at least in 8 to 10 years. It doesn't pay back immediately. Now, if you're thinking about a shorter time frame and a high discounting rate, obviously a street lighting project will not come as an obvious choice for you. And of course, when these guys go out to the financing sector to borrow money, the banks don't understand energy efficiency either. I mean, they would rather fund a car loan or a housing loan, but if you go and tell them that I'm going to replace my water heater or a furnace with a more efficient model, I think there's always, not in the United States, but many other countries, there's a hesitation, because there the logic is, so you're paying for this, but what is the benefit you're getting? The benefit you're getting is over the time period of 10 years, over your reduced electricity bills or gas bills. And it's not from selling something like a revenue generation, which will be the benefit. And I think banks don't understand, they're not set up. Even many of the progressive banks in many countries have very little energy efficiency funding going on. They do a lot of renewable energy funding, green funding, but the energy efficiency portfolio always seems to be smaller, except for a few countries, of course, which have done very well. And again, as I said, the smaller size of project makes it higher transaction costs. I mean, right? I mean, if you have to save a megawatt by using 1 million light bulbs versus you have to generate a megawatt by putting one power station, obviously that 1 million light bulbs is a much more complex process. That will probably be divided between, I don't know, 1,000 buildings. You need probably 1,000 contractors to do this. So it becomes more and more complex when you go down to the smaller size of the projects. And again, we have talked about ESCOs, and we'll talk about it a little bit more, but that's one of the solutions, energy service companies, to solve it. But does it really work everywhere? We will find out. I'll try to rush through a little bit because I think the examples are more interesting. So this is really, again, a map to show that you always have to have a combination of policies and incentives to what we call nudge this market and do the market transformation. Even in the United States, if you think about how energy efficiency started in the 1970s, a lot of public funding came in, a lot of regulatory policies through the regulators came in, which convinced utilities to do energy efficiency, which started the Escrow industry. The Federal Energy Management Program around the corner is based on that model, where you put in incentives to attract consumers to do more energy efficiency. Also, United States obviously had the policies in place. California started with the standards, and then we have the Energy Policy Act. The same logic really applies everywhere, that you have to start, policies and regulations take time to ramp up over time. So you really need to get it started with incentives in the beginning, because otherwise, if you really rely on policies, put a building code and expect that thing will happen, it doesn't happen. Many of these countries have had building codes for ages, but the implementation has been very, very poor. Unless you put in some incentives to trigger the use of that policy. And I think this diagram really shows that, that's how you do it. The other point it shows is that you almost always have to start with public finance and slowly move to private sector finance. Public finance cannot solve the entire problem. And I think that is the point. This I will call the 5 pillars of energy efficiency, which is very, very important. Policies and regulations, as I mentioned, institutions, which you really want, like either the Federal Energy Management Program or the Bureau of Energy Efficiency in India, or Procel in Brazil, or DED in Thailand. Those are the institutions which you need to have in place, which have the agenda and the mandate to push energy efficiency. You need financing, technical capacity, and awareness. Problem is, you see in most developing countries that those two are there more or less. Policies and regulations can be pretty much copied from another place and put in minimum energy performance standards, for instance, for appliances. Not that difficult. And many countries have done that. The problem is with this financing, that is where many of these developing countries are very weak. And it's not happening because the 5th pillar is missing there. Awareness and technical capacity always, there's room for improvement in the developing world. But what we have found is that On the first two areas, most developing countries have done quite well. This again kind of shows a little bit of a difference between how renewable energy and energy efficiency on the McKinsey cost curve would be treated through a mix of policy and financing instruments because of its specific issues with energy efficiency, which is the market and the financing barriers, not the cost barrier. There's a difference between what we call cost and financing. Cost could be low, but unless you can bring financing to that, it doesn't work. And that point brings me to the point that there is this concept, or I would say perception of people that, the agencies like the World Bank or the Asian Development Bank and all these rich countries can really solve this problem with public money. No, because you really need $400 billion of investment per year between now and 2040 to achieve the 2 degrees Celsius target, which I was showing in the previous IEA graph. Now, even if you add climate finance, CTF and GEF and GCF and whatnot, World Bank, it's hardly 10 or 15% of what you need per year. So point is that you have to trigger private sector capital mobilization. Without private sector involvement, the energy efficiency target cannot be achieved. And many of these countries which have actually done well in energy efficiency are the ones where the private sector has been very, very active, or have been encouraged to come in, or the environment was set up in such a way that the more private sector did come in there. This is how the World Bank looks at it. I mean, if you look at how our development finance and countries finance and private sector comes in, along with GEF, CTF, and other climate mechanisms, what I say is that we try to make the investments financially more attractive from this side, but then you need a whole set of policy environment and program environment to make it sort of more attractive for people to implement, right? It's easier to implement. I mean, you cannot, as I was saying in the 5 pillars, you cannot have one without the other. You need really both to have the market transformation. This I'll skip, but energy efficiency is a key part of World Bank's group's commitment because of our climate change action plan and SE for all and sustainable development goals. It also actually fits within our broader 2 agenda, which is a shared prosperity and poverty reduction. That's the ultimate objective of the World Bank. And if you look at it, energy efficiency does help fit into that agenda, either making it easier for people to become more efficient, but also then you move those reforms in those markets, which makes the system more efficient and provides more electricity to more people, thereby helping poverty reduction. Or through the quality and reliability of public services, you are actually creating more opportunities for the poor. And so if you really look at it from different sides of this, energy efficiency is kind of a non-controversial action, which obviously therefore World Bank has gone into this in a big way. This diagram also shows that same sort of fact. And if you look at it, the numbers, I mean, we have had about $1.5 billion of investments every year. Much of this, of course, has been on the supply side energy efficiency, but I would say the demand side energy efficiency, this portion is actually gradually increasing now. And our effort in the bank is to really see more and more of this share going up. Of course, the supply side efficiency, where you make power stations more efficient and transmission losses going down, that's important too. And we do continue to work on those areas. But the effort is more into the demand side areas. And how does it, as I was saying in the first cut, because of the multiple benefits, how does energy efficiency help individual countries? Now, in some situations, you can say that energy efficiency will, help in, the infrastructure, electricity bottlenecks. It's basically addressing by bringing efficiency, thereby releasing some of the electricity capacity available to do some more productive work. In some other countries, it's simply a matter of energy security. I mean, many countries depend highly on imported fuel, and therefore that becomes an objective. And in many countries, the last point is energy access. We keep talking about 1.5 billion people not having access to electricity. Now, in many countries, we have seen that if you can bring in energy efficiency, it really releases a lot of capacity which exists to provide more access to people who don't have electricity connections, for instance. Even in the off-grid context, when you put in a solar power or solar mini-grids or rooftop solar or solar home systems, you can really make it much more attractive financially and much more impactful if you bring in efficiency along with solar power. So in all our projects now, like in Bangladesh, we are doing a project where we provide solar home systems, but along with the solar home systems, we provide LED lights, we provide efficient black and white television set, and even an efficient ceiling fan or a table fan. Now, if you didn't do that, then that solar panel of 80 watts or 50 watts is not going to serve much in that household other than lighting one light bulb. But when you give them as a package, it makes that what we call, you can take a lot more juice out of that solar panel. So what happens is in the access context also it's very important, off-grid as well as grid. When we do these implementation models to transform the markets, what do? We work either with what we called, this is like the ladder. You really start with public financing and go to commercial financing, or you can look at it the way saying market maturity, which means that if I go to Africa, I cannot talk to them about green mortgages and green bonds and ESCOs, because they probably don't have the financing sector in many countries set up to absorb that model. So you really start with the basic. You work with the utility there, because every utility, every country, no matter how small, would have an electricity company. So you start working with the electricity company. So what we call electricity demand side management or on-bill financing. You go up the ladder and you hear about this concept of ESCOs, energy service companies, and super ESCOs. You go further up, you bring in this risk-sharing mechanism, which is more sophisticated markets where people are putting in money, but they really don't need the money in the sense that there's a shortage of, or there's a liquidity problem. It's that the money is not flowing into the right agency or the right ESCO. And you really bring in risk sharing, which means that you just cover the risk part of that transaction, not the transaction as a whole. And of course, there are green bonds and other, vendor credit and commercial financing. So most of our work in the World Bank has been around along this ladder. And it really depends on the country's context, which sector are you looking at, or what kind of regulatory environment is there? Are there policies around? And that defines which model to pick up in a particular country. And again, this is an example list of different models in the residential sector, in the public sector, in the industrial sector, which will be a little bit more clear when I show you the examples of ESCOs, for instance. I wanted to focus a little bit more on the ESCOs because we just did a paper on how ESCOs could be a solution, yet not the only solution, and does face problems. So an energy service company, as you know, is really more of a technical and financial service provider, which comes in and does energy efficiency actions based on performance and gets rewarded based on performance. Sometimes they invest, and they are the ones who take the risk for the credit also, not just the technical risk of performance. And this has been kind of considered as like a magic bullet in many countries. In the US, it worked quite well. In Europe, it has been a good model. Chinese market has really become very, very popular with ESCOs. And yet, it's not that it's the only solution. For example, in France, what an ESCO does, this is a chauffage model, is that they basically come to a facility like this, and they would say that, WRI, you don't have to pay the electricity bills. From today on, I will pay the electricity bills for you. Leave it for me to decide how I'm going to fix all these things. It's my responsibility that you get enough light, enough comfortable environment, cooling, and that's all you need. So that's kind of the typical French model which has been used. But I think the more popular model are where we call what we call the guaranteed savings and the shared savings ESCO model, where an ESCO let's say I'm the ESCO, I come in and Vijay is the owner of this building or running this building and paying for electricity, and Debbie is the financing institution. And I come in and I say, I'm going to borrow from Debbie, and I'm going to have a performance contract with Vijay, where the performance contract will guarantee a certain savings. He doesn't have to invest. I take the responsibility because I take the risk. So I get a larger share of that savings, which pay for my investment, which I pay back to the bank. And I take the profit and I leave. What happened that he didn't have to invest anything, but he got a system set up which will help him in achieving less and less, I would say achieving more savings, continued saving in the future, even after I'm out of this business, this deal. Bank is happy because I have taken, I've done a performance contract which is legally bound, which kind of guarantees that, yes, there will be savings, because the bank doesn't understand whether an LED bulb really saves or not. But that's where the ESCO's credibility comes in. What if he borrowed directly from Debbie? I could just come in as a technical guarantor. He's not going to pay me that much of the share of savings, but I'll get my consulting fees. So that's what we call the guaranteed savings model. So there are various ways of doing this, where you bring in the financing on a large scale. And US is one of the big markets of ESCO. China has become very, very big. We have not had enough success in India, quite frankly, because of many other issues, that ESCOs are not financially that credible either. And banks have a lot more stringent requirements when they talk about lending to ESCOs. But there are examples around the world, from Korea to Germany to France, where this is the way of bringing large-scale financing, where you would not have any other entity doing this kind of work. And this does sort of lead to another concept which you're seeing more popular, becoming more popular in the last 5 years, is what we call a Super ESCO concept, where a public sector company, through public financing, is set up to actually bring in all these ESCOs under its fold and start doing the business. In fact, the Federal Energy Management Program in the United States in 1990s really started with that concept. They don't claim that they're a Super ESCO, but that was the main basis of how they started providing this comfort zone to the owners of the federal building by stepping in. Because if Vijay doesn't know me, he's not going to do business with me. But if I have the public sector on top of me as a Super ESCO, then he will do business with me. See, that is the concept where the Super ESCO comes in. And we are seeing more and more of this happening around the world. So the bank has been working on this in India and in Saudi Arabia and other places. But this, for example, in India, there is a Super ESCO called EESL, which many of you are aware of, and I think you have visited them in the past. And they basically grew from a $5 million company to $200 million, and their target is $1.5 billion in the next few years. So this is the kind of business they're doing, that they are basically aggregating all this demand and bringing the private sector to deliver the services to meet that demand. And in the process, what they have done is, for example, this Super ESCO would go to a financial institution, borrow, even including the World Bank they will borrow from. Then they will go to the electricity distribution company, buy light bulbs through the distribution agencies, give it to the consumer, and through the energy savings the distribution company will pay back to EESL, which pays back to the financial institution. In the process, what they have done is they've aggregated this consumer demand and distribution utility demand. And when they go out to the market, they are the ones who are purchasing this equipment. So the distribution company, as I said, sometimes is not set up for procuring this kind of equipment. They don't do energy savings procurement. But this ESCO, the Super ESCO, does this procurement. So for example, for a 9-watt LED lamp, which they started procuring about 4 years ago in bulk, like tens of millions and hundreds of millions of them, it used to cost them about $5, $6 US dollars. Today, when they do this, it costs less than $1 US. This is Indian rupees. So this is the power of this super ESCO, which is sitting on top of all the private sector ESCOs and the demand, and bringing the two together and playing this role of facilitation, basically. And it's always invariably funded by the public sector. So it's really public sector financing which comes in and takes the risk. They're doing the same thing in street lighting. They have done 6 million street lights, which is a pretty serious number. It's actually a world record for any country to do 6 million street lights in like 3 years. All with the same concept. They will go to the municipality, aggregate hundreds of municipality demand, buy street lights in bulk. Through these individual private sector, they will install it, and they will then get paid by the municipality from the savings. So I think this is like one of the non-subsidized models. So there is no climate finance involved or no grants involved in this kind of approach. The same approach has been done in Belgium. They do the same thing in public building sector in Belgium, where the FedEsco, which is the public sector super ESCO, works with private ESCOs and with the bank to bring all these players together. Same is in UAE, in Dubai. They're doing hundreds of buildings, just like with the same model, that the public sector in Dubai has put in funding with this company called Etihad ESCO, which is bringing the building energy efficiency demand and the ESCOs together. Armenia, the World Bank did a project which is again the same concept, where we have what we call the energy service agreement. So this contract which I was talking about between the ESCO and this end user is what we call an energy service performance contract, or an energy savings agreement. And that terminology differs, but the concept is still the same, that it's performance-based funding and performance-based lending by the bank and performance-based investment as a whole. All we talked about, these ESCOs or utility demand side management, or let's say minimum energy performance standards for appliances, everything works really well when you have a good regulatory environment in a country. It's absolutely necessary, as I showed in the first graph, that ramping up of regulation. So when you look at the United States, the regulations have really ramped up to the maximum extent and everything works well. But the same regulation takes time, let's say in a country like Bangladesh or in Nigeria, where they may have a minimum energy performance standard, but they may not have the capacity to implement that standard. So what we did in the bank a couple of years ago, started looking at this. You might have heard about something called the Doing Business Indicators of the World Bank. So Doing Business Indicators of the World Bank provides a very good sort of knowledge base to many private sector investors who are going into a country before they want to invest, almost like the credit rating of a country. So let's say you are an IT service provider, or you go to let's say Kenya, and you want to do business, you want to set up an IT manufacturing unit. Where do you go to? You kind of start with this Doing Business Indicators, that how easy or difficult or how good it is in the Kenya for a private sector to come in and invest. We did a similar things for the energy efficiency part of the whole thing. That if you look at the 111 countries which we did, where do they stand in the policy and regulatory environment to be able to attract investment? As I said, 85% of the investment has to come from private sector. Public sector cannot solve this problem. But the private sector doesn't invest unless they're sure that there will be return. And how do they make sure that there's a return? If there's a good policy in an institutional environment. So this RISE, you can do Google on, you can go to that website, you'll find that every country has been mapped in terms of their, where they are on the policy scale. And it's not just based on one policy. There are like 25, 30 indicators for each areas: energy efficiency, renewables, and access. So this, I think, is a very good tool. Just an example, I picked up Bangladesh just because when I opened up, it showed up in my computer, so I took a screenshot. So it will give you a score, like the color, green, orange, yellow, kind of gives the comparison with other peer countries or peer markets. And you can dig deeper. You can find out why are they 23 in energy efficiency, why are they so low? What is missing out of those 5 pillars, which I showed in the first chart? Do they probably don't have enough capacity or not enough awareness, or maybe financing sector is missing. So this really is a live sort of database, which we are updating actually right now as we speak. The next version is coming out. This year's update is coming out, which actually helps you look at the country, what they have done, but also what they should have done vis-a-vis some other countries which are in a much better position. So this really maps all the indicators, like do they have an efficiency planning system? Do they have the institutions? Are consumers made aware of energy efficiency? What is the electricity rate structure? Is there a basic problem there? The rates are very, very low. So it really maps out all the parameters and indicators which you would think would make a policy environment more and more robust, and gives more confidence for investors to invest more. And again, I'm not talking about foreign investors. I'm talking about private investors, domestic investors within the country. Like if, let's say in India, if Tatas were to move from telecom to invest in energy efficiency business, they need to be clear that that's going to bring in returns. And how would they make sure that it would? This is one of the tools which helps in that direction. And again, the point is that the market transformation would require private sector investments. So I really need to summarize here by saying that, well, you really need the combination of policies, incentives, and market mechanisms. But this institutional framework really is the most important thing. You can have all kinds of business models. We talked about ESCOs and DSM and others, and of course financing. And then of course, information awareness really cannot be ignored. It all has to work together. And that's why it's a complex ecosystem. Energy efficiency is not, as I started by saying, it's not as simple as putting in a power station. It may be cost effective, but it's cost is not the solution. It's the financing which addresses the cost problem, which is not there. And again, coming back, that ideally you would have a situation where every country would have a green check mark for all those 5 boxes. And that's where you see those countries coming up top. Denmark, for instance, why is it number 1? They have all those 5 boxes checked. Or even Korea and Japan, if you look at it, why are they so good in energy efficiency? This reflects the performance. When you have those 5 boxes, you really see those energy intensity curves going down while the GDP is going up in those countries. And I think that decoupling is possible, and we have seen there are examples that it's possible, but you really need all 5 of those boxes to be checked and to be in place. Just providing one doesn't help. And many times we have seen, including many donors and many agencies, would really pick up one of the things and think that it will transform the market. But market transformation would require all of those pillars to be addressed. That's really my final message. And again, thanks a lot for being a patient listener. But we have a lot more information on our website. If you wanted to check it out, we do have now a little bit more organized, systematic way of putting things in one place. And again, happy to answer any questions now or later. My email is there in the presentation, last slide. Again, thank you very much.